Let's bring in a couple more voices to discuss the markets in more depth. Catherine Rooney Vera is head of global research and chief investment strategist at Baltic Capital Markets, and Brian Levitt is global market strategist for North America at Invesco. Very good morning to you both. Brian, I'll come to you first. This recent rotation, we've seen attempts at it quite a few times over the course of not just the last couple of months, the last couple of years. Do you think it lasts this time?
Yeah, I think it lasts for a while here. I mean, we're following a pretty consistent pattern that you would expect in a recovery. You would expect to see at some point the more economically sensitive parts of the market start to participate, and you're starting to see some better signs with regards to cases. There's obviously a massive policy response from the Federal Reserve. We're likely to see, at least the market is expecting to see, more support on the fiscal side. And then obviously there's some hopes around therapeutics or vaccines, as you're talking about this morning. So if you believe that this recovery is going to continue to persist, even if it's at times feels like fits and starts or intermittent, you should expect the more economically sensitive cyclical parts of the market to continue to participate.
Catherine, do we need to see a stimulus deal, full stimulus deal through Congress for that to continue?
Well, I think the market is precipitated on that eventuality. So if we don't get an additional fiscal stimulus, then I think it will paint ugly for the markets going forward. Let's face it, we're at very close to all-time record highs. And the main driver of that appreciation in the S&P 500 has been stimuli, both fiscal and monetary.
Mike, I mean, clearly hard to pinpoint exactly what the markets are moving on this morning, whether it is that Russian vaccine news. But interesting to see the 10-year go back above 0.6% this morning. That's a relatively meaningful move, and I guess does paint some optimism towards the broader economy, whether it's linked to a vaccine or not.
Yeah, it definitely means a little bit of a retreat from that safety bid in bonds. It also would support the idea of perhaps a more cyclical tone to the equity market, because, you know, this extremely low yields, very negative real interest rates has been a backdrop for all these long duration, big growth stocks. That's the academic answer for why the NASDAQ has been doing what it's been doing. And if you have a reversal of that, also a lot of Treasury supply coming out this week, 10s and 30s. So maybe the market is gearing up for something like that too. But it is in gear with this idea that we might have a phase where the cyclical stocks can do some catch up.
Catherine, if you're a U.S. equity investor, do you welcome this weaker U.S. dollar that we've had of late?
Well, certainly it's a positive, and I'll tell you that the combination of variables that we have right now is very fortuitous for the markets, which is why they continue to move higher, driven mainly by retail investors, which we know the Barron's article came out very recently saying that 25% of recent market moves is brought on by retail investors. What I think is the bullish case here is the potential for a real vaccine. Maybe it's not the Russian one, but potential for a real vaccine in the course of the next 6 months. If that's the case, then we have that fundamental base, which is that nation growth and U.S. consumption solidified. And if that happens, then this V-shaped recovery that we've seen thus far really has legs. From there on, Wilfred, what we need to see is some retractment of the fiscal stimuli, because really what we're seeing now makes the Lehman Brothers reaction seem like child's play. We're talking about trillions and trillions of additional fiscal stimuli in the market that's already at record highs, with consumption already growing, exacerbated by a Federal Reserve that's really dramatically increasing its balance sheet. So,
Brian, would you therefore similarly be very bullish for 2021, 2022?
Yeah, I think we're going to have a long cycle here. And, you know, it's similar to how we came out of the 2008 financial crisis. I mean, things didn't look good for a while. It takes a while to repair, given the extent of the downturn that you have. But the market doesn't care if things are good. They care if things are getting better. And so what you should expect over the next couple of years is things to get better at a gradual pace. And given that it's a gradual pace, we're likely to see policy accommodative well into the future. And in a modest growth, accommodative policy environment, that should be very good for stocks, and that should be very good for credit, similar to what we saw in the aftermath of the 2008 global financial crisis.
Catherine, Brian, and Mike, thank you all for joining us.
Thank you.